Let's talk about one of the two vols, volatility. The other one's volume. We'll do that in a different video. Hey, I'm Rod, the Futures Fanatic. I've traded the futures markets actively for over 30 years, and I created this channel to provide education for active futures traders and self-directed investors. I'm glad you're here. So in light of recent market volatility, and we'll get into that in just a moment, significant declines in the markets, I thought it was time for me to do a quick lesson about volatility since it's often misused and misunderstood and misused if it's used at all. So in this video, I'm going to teach you three things. First of all, how to measure volatility and calculate it in a useful way for day trading, why volatility is where you need to start with any strategy or approach to active short-term trading, and then I'm going to go into three actionable trading tactics that you can use immediately to implement what I discuss in this video. Let's get into it. So as I said before, in active trading, really only two things matter, the two vols. That's volatility and volume. And the reason this is the only two things that matter is because it provides a framework for how to understand and adapt to everything in trading. And also, I'm making this video, so I'm telling you those are the two things that are most important. So first, let me give you a definition of volatility because it ain't what most traders think or hear in that trading echo chamber, especially that you see here on YouTube. So if you Google volatility, you'll often find a definition like this, which is it's an investment term that describes, when a market is moving around pretty erratically and unpredictably. And in this definition, is saying sharp price movements. Well, let me tell you why that's essentially incorrect. So first of all, volatility has nothing to do with anything predictive. In fact, that's not the business we're in. We're in the business of probabilities, not trying to predict anything. And in terms of sharpness or a sharp price movement or an unpredictable, it's only significant if it exceeds an expected range or a distribution of probable outcomes. I'm going to get to that in just a moment. So also, volatility is not the speed of price movement, how fast something's going, how fast it's falling or rising. The price velocity and rate of change is not actually volatility. It's not whippiness or when markets are wild and erratic, unless again, the price movement has exceeded its particular ranges. Again, I'll get to that in just a moment. And then finally, and this is most important, volatility is not a fear index or a fear measurement. You'll hear this on CNBC and Bloomberg when they're trying to describe the VIX. Okay, you'll hear that related to the VIX, which, by the way, did go up 300% in the last 10 hours. So yeah, that VIX move was indeed volatile, but the VIX actually reflects options pricing, which is for another video. So anyway, the best way to measure volatility for the purposes of improving your active short-term trading is to look at standard deviations of returns. But that too is a bit wonky, and I went to California school. So we're going to use another more simple measure of volatility and simplify the whole process. And it's going to be called the average true range. Now, you've probably heard of the average true range before. It's an indicator that's just measuring movement, but I'm going to teach you how to use it in a completely different way. So first of all, to make volatility approachable and actionable, we're going to think of it simply as the recent range of prices. So over a given period, what is the expected movement in price and what percentage of that range has price covered in any given trading session? Okay, that's a mouthful, so let's get into it a little further. So I'm a futures trader, and this is the Futures Fanatic channel. Welcome here. If it's your first time here and you're digging at the end of this, stick around to the end, or even right now, give a thumbs up, subscribe, turn on the bell notifications. All the active social things to do. Again, I'm here to provide no fluff education for active futures traders and self-directed investors. Okay, so since we're trading the futures markets, if you're unfamiliar with them, they trade over a 23-hour session. They actually close every single day at, I'm going to give it to you in my time here in Las Vegas, at 2 p.m., and they open again at 3 p.m. Okay, so they're only closed for 1 hour. You can adjust to your own time zone. Other than that, they're going to trade basically Sunday evening all the way through till the Friday close, so 23-hour sessions. So please don't trade for 23 hours in a row. That's not the session we're talking about. We can adjust everything for the trading periods when we're in front of the screen. So for my community, our trading sessions are Monday through Friday from 8:15 a.m. Central to 10 a.m. Central. And you can check the description down below if you'd like to find out more about my pro trading room, where we actively trade the futures markets for daily income, and we're focused mostly on prop trading programs where you can learn how to trade without risking any of your own capital. Okay, again, the description for all that will be down below. There's no credit card required. There's no upsell. There's no nonsense. There's nothing to cancel. Just great education and a fantastic community. You can check it out below. So now, I love golf, so this is going to be my first golf analogy. We make most of our club selection decisions based on the yardage of the hole that we're playing, right? So you can think of ATR the exact same way. How far is the hole, or how far has the market moved already? And in some cases, when we're selecting our next club, how far do we hit the ball and how much do we have left to go? So now I keep saying recently, so let me give you the actual period that we're going to use. We're going to use the 7-day ATR, average true range, with a session time set to 24/7. Okay, so let's look at some examples. Okay, so what I brought up here is the market analyzer from NinjaTrader. Now, if you don't use NinjaTrader, you don't have to worry about this. I will give some examples of how you can calculate the ATR using other popular platforms like TradingView. In fact, we go through that in my trade room. But if you are a Ninja user, and again, if you check out our trade room, inside the trade room, we offer all of this, and it's all included. So you can get this workspace that has this market analyzer in it, and we'll calculate these ATRs for you. So the column that we're going to focus on is right here. It's the 7-day ATR. And let's look at it for the MES right now. And again, I'm making this video because we have just recently experienced true volatility, which is essentially range expansion and price moving over much of that range on a daily basis. In fact, I'll give you an example in just a moment where you see how much prices actually moved. So the 7-day ATR is what we want to look at. And I'm going to just use the MES as an example. So this MES currently has a 7-day ATR, the expected range for each particular trading day. By the way, why 7 days? Did a ton of back testing. It's the most relevant one. It's kind of like an exponential moving average where we're using more recent data. And then you do a 7-day, it kind of takes out the weekends and holidays sometimes. Okay, this is the most relevant measurement. So the MES currently has a 7-day ATR for 1 day. That means that the expected price movement will be 125 points. Now, if you're not familiar with what that number really is, and most of you probably wouldn't be, that is about 2 to 3, almost 4x what it can typically be. So we have recently experienced a massive jump in volatility, and here's how we're going to actually use that. By the way, if we measure from, this is just the trading session from the other day where there was a whole bunch of actual volatility as measured by price expansion and price going over all those periods. Excuse me. So we're going to go to the ruler here. We're going to measure from here to here. This line up here, by the way, is the prior session high. This line down here is the prior session low. Okay, that's 226 points. So now what we're going to start to do is think in terms of percentage ATR. This is how we actually make it applicable, and we can have real tactics that we use. So a 226 movement against 124 expected, it is quite a bit. Let's say it's not quite 200%, but it's 180% ATR. That is highly, highly, highly unusual. All right. Now, that doesn't make a whole lot of sense. What am I going to necessarily do with that, Rod? How am I going to make this a little bit more actionable when it comes to something like that? Well, let me give you an example. So what you can do is you can say, okay, I'm going to now use my stops in terms of doing something dynamic with ATR. All right. So the ATR, as we saw before, was 125 for the MES. We've done a lot of back testing, and we found that 20% of the ATR is a good stop to use for an instrument that you're trading. So remember the MES before, right back here, the MES was 125 points. We take 20% of the 125, and that gives us, I'm not very good at math, I think I can do that on the fly, 10 to maybe about 25 points. Now, that seems simple, but it's very, very powerful, because what are most people doing with their stops, right? What they're doing is they're using something like a prior swing high or a swing low or a Fibonacci level or maybe a moving average, or the worst is something fixed, like trade the S&P, the MES or ES market, and I risk 5 points to generally make 5 points or make 10 points. Okay, that's going to be very, very difficult because you're not adapting to what's actually going on. You're just playing the entire golf course with a putter, right? You need to know what your yardage is so that you're using the right club for the particular hole that you're playing and where you are, right? So when we apply volatility as measured by the ATR, and then we give it a percentage. Now, where do we come up with 20%? We can talk about that later. Again, a lot of this has to do with some back testing. Sometimes it could be up to 25%, and in lower volatility environments, the percentage of the ATR can actually come down, but we'll get into that maybe in another video. Hey, hit the like, subscribe, turn on the bell notifications so you can be alerted to when we revisit topics like this. All right, so there you have it. That's one way to actually implement an ATR, a measurement of volatility, and apply that to your trading. The other thing that's great about using this is that is your individual stop, okay, based on where you got in. We're not even talking anything about strategies, right? But it has nothing to do with market structure, which is where a lot of people might be hanging out. It has to do with where you got in and using a dynamic value, 20% of the ATR, measure the 70 ATR, take 20% of that value. You have a dynamic stop. You're welcome. All right, now let's talk about next thing you can do with ATR, which is I'm bring up my our pre-market trading checklist. Again, another quick pitch for the Pro Trading Room, Monday through Friday from 8:15 Central Time to 10 check the description below for how you can join for a 2-week free trial. You get access to this every day. Now, this is more than I can go through right now, but the value that I want you to look at right here is the percentage here, okay? What we're measuring is we're measuring the percentage, and we take this measurement at about 5 to 6 a.m. Central Standard Time every day. We could take it at various different times. You have to pick a time where you measure this. And what we're doing is we're measuring the amount of range that has happened. Right now, as I'm making this video, it's evening time, and the market has already moved 33.75 points. There'll be times in which that's the entire expected range for the entire day, and right now it's already moved about 30 points. So 30 points would be of 125 point, 100 ATR. It would be approximately 25% ATR, if you will, okay? Now, here, as you can see, this was 50% the MYM moved, 62%, 66, and 64. This might feel like you're walking right into the middle of the movie. Hey, how do I make that actionable? Here's what we're saying with that value is what we're looking for is we want to see when we start trading in the morning. Most active day traders trade the New York session open, okay? And if you are not able to trade the New York session open for futures trading, you probably don't want to be a futures trader. I know they trade 23 hours a day, but it's best if you can actually watch and trade the open because that's when most of the action actually happens. Now, we want to be able to understand how far, I'm going back to the golf analogy again, how far did we hit that first ball? How much yardage do we have left? In other words, when we're ready to trade of the expected range in the MES of 125 points right now, of course, if we don't get this kind of volatility in terms of movement of price within that expected range, that number will come down and we'll make adjustments. But what we want to know is how much range has already happened. You can hear probably some orders going off. I'm actively trading while we're doing this. So that's a bit of a distraction. Back to my train of thought. So what we're looking at here when we're measuring the percentage of the ATR is simply just to calculate or provide us a framework for whether we want to start trading when the market fully opens. In periods of very low volatility and where the range is very low, there hasn't been much price movement, we generally might want to wait until we get closer to 50%. Then we have more data and more information to work with. And on days in which it's over 50%, we can begin to get involved right away. We tend to use volatility and volume-based strategies. So once there is enough volatility, price movement, again, these definitions, overlap a little bit because, again, it's not really volatile if it's within an expected range. We're just talking about the amount of range that's actually happened, okay? So we look for more than 50% when we start trading, and then we know that we can start trading. If not, we sit on our hands, we generate AI art, we have a very good time. You can check out the description below for a 2-week free trial. All right, and then the final thing that you can do with volatility is you can use it to measure essentially everything in a percentage of ATR. So let me give you an example. What we want to do is go look for what we would call an expansive candle. And why would we call it expansive? So let me just measure this candle right here. We're going to go from here to here. I'll crop the wicks a little bit. That is a 46-point candle in the MES. Again, we're talking about a 30-minute 46-point candle. If you're not familiar with futures markets, we will be trading an entire session that might not be 40 or 50 points at some point again. I'm making this video because we are in a little bit more of a higher volatility environment. Now, what we do is we measure everything. We say, what percentage of ATR is that particular candle? 46, again, probably more like a 40% ATR candle right now. So when we see any candle that's over 30% ATR, we do not get involved in that candle. All right, we're not trying to pick a bottom. So it just keeps us out. We call it an expansive candle. All right, so an expansive candle is anything that's 30% ATR or more. But here's what's so powerful about using volatility in ATR is that it's constantly changing, because as the volatility profile changes, our definition of an expansive candle will change because it's a percentage of a variable that's moving, right? That is how we adapt. That is how you actually develop what we call situational fluency. How do we measure something so that we become situational to what otherwise feels like chaos? I started this video by saying a lot of people describe volatility as erratic price movement, things going up and down, and choppiness, and things happening quickly, and all those types of things. If you want to think of it that way, that's fine. But instead, wrap a actual framework around it. Use the ATR to measure what's actually happening within the probabilities of ranges happening, and then just start to measure everything in terms of ATR. See how that does for you. So there you have it. We covered volatility, and in the next video, I'll go into volume in quite a bit more detail. The two vols, volatility and volume, essentially all that matters. Thanks for watching. My name's Rod, the Futures Fanatic. We'll see you at the next one.